today is about preparation of financial statement part 1. So general purpose of financial statements are provide financial information about the reporting entity that is useful to existing and potential investors, lenders, and other creditors in making decisions about providing resources to the entity. Are prepared on an accrual basis, meaning the most transactions are recognized when the event of performance obligations occurs, not when cash is paid or received. The four primary financial statements are statement of comprehensive income, statement of financial position or balance sheet, statement of changes in equity, and statement of cash flow. Statement of comprehensive income. This statement outlines the revenue and expenses over the year. It also includes non-cash transactions such as depreciation and increases of decreases in the value of assets. Most not-for-profit entities aim for a break-even position or small surplus to allow them to reinvest in their business in future years. While statement of financial position, the statement of financial position presents all the assets of the entity at year end and how they are funded. For example, through liabilities and equity, assets and liabilities are split into current and non-current, which generally means if they are expected to be settled within 12 months. Also, the statement of changes in equity. The statement of changes in equity explains what the government's or owner's interest is comprised of. It also highlights the movement between the various classes of equity. The most common classes for state entities are contribution by government retained surpluses or deficits and the combined increases in the value of the assets they administer. For the statement of cash flows, the statement of cash flows categories all cash payments made and received throughout the year in 3 groups: operating activities, investing activities, and financing activities. While financing activities are cash flows relating to how the entity is financed. It covers equity injections, returning equity to government, and taking out or repaying long-term borrowing. While change in titles, old name, while before the old name is balance sheet, the new name now is statement of financial position, which I already discussed on the previous slides. Also, the income statement is the statements of comprehensive income, while cash flow statement is the statement of cash flows in the new name. The purpose of financial statement are structured representation of the financial position and financial performance of an entity. It is to provide information useful for decision-making and to demonstrate the accountability of the entity for the resources entrusted to it. While the purpose of financial statement, providing information about the sources, allocations, uses of financial resources, also providing information about how the entity financed its activities and met its cash requirements. For the purpose of financial statement, providing information that is useful and evaluating the entity's ability to finance its activities and met its liabilities and commitments. Also providing information about the financial condition of the entity and changes on it. So here, as we discussed in financial statement in the previous slides that I have discussed to you, the financial position are, the composition of this is the assets, liabilities, and equity. And also in the, for financial operation, which is the income statement, it is the income or the sales and expenses, and the equivalent of this is the profit or the income of the operation of the business. So the purpose of financial statements providing aggregates information useful in evaluating the entity's performance in terms of services, cost, efficiency, and accomplishment. For the complete set of financial statement, a statement of financial position as at the end of the period, a statement of comprehensive income for the period, a statement of changes in equity for the period, and a statement of cash flow for the period. Guidelines in the presentation of financial statement. or each component of the financial statement shall be clearly identified, and the following information shall be emphasized for a proper understanding of the information presented. The name of the reporting entity, or whether the financial statement covered the individual entity or a group of entities. The period covered by the financial statement shall be specified. The statement of financial position is a formal statement showing the three elements comprising financial position, namely assets, liabilities, and owners' equity. Also, investors, creditors, and other statement users analyze the statement or financial position to evaluate such factors as liquidity, solvency, financial structure, or capacity for adaptation. The financial structure is the source of financing for the assets of the enterprise. It indicates that what amount of assets has been financed by creditors, which is borrowed capital, and what amount of assets has been financed by owners, which is invested capital. In liquidity, it refers to the availability of cash in the near future after taking account of the financial commitments over this period. Also useful in predicting the ability of the enterprise to meet its short-term financial commitments as they fall due. While solvency refers to the availability of cash over the longer term to meet financial commitments as they fall due. Useful in predicting the ability of the enterprise to meet its long-term financial commitment as they fall due. So the capacity for adaptation is the ability of the enterprise to use its available cash for unexpected requirements and investment opportunities. This is also known as financial flexibility. So the classification of an assets are under the assets class, there is a current assets. The assets is cash or cash equivalents unless the assets is restricted from being exchanged or used to settle a liability for at least 12 months after the reporting period figure. The entity holds the assets primarily for the purpose of trading. And for the current assets, the entity expects to realize the assets within 12 months after the reporting figure. The entity expects to realize the assets or intends to sell or consume it within the entity's normal operating cycle. Again, class. For the current assets or later on the current liabilities, it is expect that it must within 12 months. Like for example, may accounts receivables ka na may distributor ka na nag-utang sa iyo since you are a manufacturing company. And then you have an accounts receivable na dapat i-collect mo doon sa distributor mo or either sa supplier mo within 12 months. So when the term said that if you agreed upon the 12 months, dapat from January, if you are using calendar year, from January to December 31, she or he must pay that accountability or that you can receive that certain account within that year. Or since if your term or mode of or term that you have given to that client or customer is, for example, 6 months or 1 year. So, kumuha siya sa iyo January 1. Dapat bayaran ka niya na sa December 31. Pag lumagpas yan, class, hindi na siya makakount as current assets. So, it will fall still under the assets, but it will fall on the long-term liabilities. And there is an adjustment later on. So again, the current assets will be within 12 months or on 12 months. If over than 12 months, it will be under the long-term assets. So the entity expects to realize the assets or intend to sell or consume it within the entity's normal operating cycle. For the presentation of current assets, these are current cash equivalents, notes receivables, accounts receivables, accounts receivables, inventories, prepaid expenses. For the classification of assets, under non-current assets, the captions of non-current assets is a residual definition. The standard simple states that an entity shall classify all other assets not classified in current assets as non-current. While in presentation of non-current assets, under non-current assets are property, plant, and equipment, accumulated depreciation, and intangible assets. Again, class, intangible assets. I know I have discussed this on the other subjects that you have. So intangible assets are assets that cannot be touched, cannot be seen, and it is costly, which is sometimes it costs millions. It is an intellectual idea like a copyright, patent, franchise, recipes. Later on, if we discuss merely the intangible assets, the list of those intangible assets, it will be given also. But it's an overview for you, or it's an advance already informed with you or discussed with you that intangible asset is a non-current asset, which is sometimes cost millions. Classification of liabilities. Current liabilities, this again class, this is an obligation. It's the same. The entity expects to settle the liability within the entity's normal operating cycle. Kung kanina, yung na-discuss natin is about current assets, or may ko-collect ka, like accounts receivables, which I have given the examples of accounts receivables. Dito naman, may babayarin ka. If nangutang ka sa supplier or sa supplier mo na kung saan ka kumukuha ng ibebenta mo or ng supplies mo or ng products mo, so ikaw naman yung may utang sa supplier. So it will be called current liabilities, or under the current liabilities if it is within the span of 12 months or within that certain year. If lumagpas ka, like for example, January 1 ka na or 2 ka nagbayad, it will not be under the current liabilities. There is some adjustments on the financial statement already, since mabibilang na siya sa long-term assets or non-current assets. The entity holds the liability primarily to the purpose of trading. For the current liabilities, the liability is due to be settled within 12 months after the reporting period, and the entity does not have an unconditional right to defer settlement of the liability for at least 12 months after the reporting period. So, presentation of current liabilities. Under the current liabilities, accounts payable, notes payable, accrued liabilities, and earned revenue, current portion of long-term debt. Or also classification of liabilities under the non-current liabilities. The caption is non-current liabilities is a residual definition, or all liabilities not classified as current are classified as non-current. Presentation of non-current liabilities under this are accounts payable, notes payable, accrued liabilities, and earned revenue, current portion of long-term debt. Also, equity. The term equity is the residual interest in the assets of the entity after deducting all of its liabilities. Simply stated, equity means net assets of total assets minus liability. It's like the capitalization or the capital that you invest or you start off with your business operation. So owner's equity presentation, it is the capital, withdrawals, income summary. However, the term equity may simply be based for all business entities. Under revised PS1, the holder of instrument classified as equity are simply known as owner. So this ends our lesson for today, or class discussion for today.